can I retire if I have $500,000 saved? If that's a question that you're finding yourself asking, then this is the video for you, because we're going to walk through a case study that's going to outline exactly what we need to be thinking about if we're going to retire with $500,000. So let's get into it. Today, we're going to be looking at hypothetical clients Charles and Laura and their journey and how they are going to retire with $500,000. Now, they're married. Charles is age 68. Laura is age 67. They are both still working, but they'd like to stop working as soon as possible. They've said, we're not getting any younger. We'd like to start enjoying what we've worked so hard to build. Now, at 67, they both claimed Social Security because that was their full retirement age, and that is what they thought they needed to do, right? So at 67, they claimed their benefit, and it helped supplement their income and allow them to save a little bit more as soon as that came in. Now, they've done a really great job paying off their home. It was really important to them that they did not have a mortgage going into retirement, and so they were very diligent, and they managed to get that paid off early. In terms of target spending in retirement, they outlined that they would be able to accomplish and really enjoy their retirement with $5,000 per month, and that's after tax. That is money that they're going to use to spend and enjoy their life and cover their cost of living. To get there, they've saved $500,000 in their nest egg between various accounts across their lifetime. So let's outline primary goals here for Charles and Laura. Stop working as soon as possible. They want to maintain their purchasing power, which really is just the fancy way to say we want to make sure that we can maintain our lifestyle and we don't have to make cuts or go back to work because of things that we did not plan for, namely inflation. Lastly, we want to minimize our lifetime tax liability. The less money that we have to pay in taxes, that means the longer our savings will last us, right? So that's going to be really important in this instance if we want to retire with $500,000. But in order to get to point B, we have to understand what point A looks like. And we always do that by looking at essentially two different statements, right? A net worth statement and a cash flow statement. So here in terms of net worth, Charles has $400,000 in his 401k. 100% of that account is pre-tax money. His particular 401k plan has never offered a Roth option. Laura has an IRA with $25,000. Again, that's a traditional pre-tax IRA, but she had the foresight to open up a Roth IRA in the past and has managed to put some money in it, and it's grown to roughly $25,000 as well. Together, they also have a joint brokerage account in the amount of $50,000, which brings their liquid net worth to $500,000. In addition to this, as we just spoke about, they have paid off their home, and that's worth $500,000 as well, which brings their total net worth to an even $1 million. And so thanks to a lifetime of hard work and discipline, they can call themselves millionaires. Congratulations. On to the cash flow side. For retirement, we're just looking at Social Security and portfolio withdrawals here. So Charles' Social Security is $2,150 per month. Laura's Social Security is $1,200 per month. They're going to need to withdraw money from their portfolio. But the big question, and the reason why they haven't retired yet, is, well, how much, and is that sustainable? And so let's dive into what that could actually look like here in another couple moments. Before we dive into answering some of these questions, let's take a quick look at their investment accounts here. Now, as you can see, Charles' 401k, the IRA, the Roth IRA, brokerage account, every single account is allocated and invested exactly the same way. And on one hand, this is really exciting to see because it means we're being intentional about how we're investing, and that's such a good thing. But on the other hand, I see a really, really big red flag here from the tax standpoint. And we're going to cover that later on. This is going to be a really big tax saving opportunity for them. But before we get into planning, we need to know what we're planning for. I always like to ask these same 4 key retirement questions. How will I create income for myself throughout retirement? What risks do I face and how do I plan for them? Am I overpaying in taxes? And is my investment portfolio appropriate for retirement, right? We want to make sure that we are being intentional and that every strategy we're implementing is tied to an outcome we want to achieve. And by answering these questions, we can make sure we're doing that. So let's answer the first question about retirement income. Now, we know that income from Social Security is going to cover the majority of their cost of living, but it's not going to cover everything. However, it's a good baseline to start from. Now, properly structured, Charles and Laura's retirement portfolio could draw about $2,250 per month pre-tax. What's really important to understand here is that, one, that's pre-tax because we need to figure out what tax planning levers we have to pull in order to then identify how much tax they're going to have to pay on an annual basis. What's also important to understand here is that the strategy that Charles and Laura are going to use for their retirement withdrawals is going to be a dynamic spending strategy. So they're actually going to start with a slightly higher withdrawal rate, and then they can increase that as their portfolio potentially increases or as inflation goes up. And this is going to help them spend more now while they're young enough and healthy enough and they have the time and energy to do all the fun things they want to do. And then they can make intentional decreases in spending later on if necessary. And again, with this strategy, we are making sure that we have a lever to pull so that as inflation increases, we can increase spending as well. The next section, security, is really what risks do we face here? In this section, I always like to cover our estate planning, long-term care, the other insurances that we might have, and anything else that could put our retirement plan at risk. So the first bullet point here is we want to evaluate, is it worthwhile to use our investment portfolio and our home equity to fund potential long-term care costs if we happen to need them? I think this is really important because at this stage, 68 and 67 years old, if we were going to go try to get long-term care insurance, one, that's really expensive anyway. Number two, at this age, it's going to be even more expensive if we can even qualify, and it's going to be very difficult to qualify. And so because of how costly that could potentially be, I think in this case, it's a really good option to look into. What if we decide to self-insure for long-term care expenses if we were to happen to need them? Next bullet point that I want to cover here, and this is actually, I would say, the number one thing that could blow up Charles and Laura's retirement plan here is the passing of a spouse, especially the passing of a spouse early on in retirement. Now, ideally, Charles and Laura get to live happily ever after for the next 30 plus years and have a really long, happy, nice retirement together. But unfortunately, that is not always how life works for us. And if one spouse passes away early, that could put a lot of stress on the plan because we're going to lose a Social Security check and we're going to end up paying a lot more in taxes. When one spouse passes away, we shift from the married filing jointly tax brackets and tax filing to the single tax filing brackets. So we're going to have the same amount of income because we still have to live on the same amount of money, hitting the tax return at more aggressive tax rates with half as much standard deduction. It's a recipe for a higher tax bill. And so what are the strategies that we're going to have to implement to hedge something like that from happening? And we're going to talk about that a lot more when we get to the tax section here in just a minute. Now, I'm always looking at our home and auto coverages, making sure we have enough. I'm reviewing our Medicare coverages to make sure that it's comprehensive enough. And if we need to make a change, we can do it now while we're healthy. And also, I'm doing a detailed deep dive review of the estate plan to make sure that our intentions and our wishes are documented correctly and can be followed. Now, for the sake of keeping this video timely, we're going to leave it at that. But in general, I'm doing a deep dive on all three of those as well. So let's talk taxes here and tax strategy. Now, the first thing we're going to need to be aware of is that in this case in particular, it is more than likely that we're going to need to find ways to maximize the use of our standard deduction. In a lot of cases, especially like this, where we have good, strong Social Security income and we're living on maybe $5,000 a month and just drawing a little bit from our retirement savings at this point in time, we might find that our taxable income is actually below zero, even though on the tax return, it's just zero. Now, we don't get any extra benefit for being below zero, and that's why we need to think about the right tax strategies to put into play to get every single dollar of deduction that we are entitled to. So how do we do that? We're going to do that with the next three strategies we're outlining here today. We're going to want to use tax-efficient withdrawals. So for this particular case, for Charles and Laura, we're going to want to draw from the brokerage account first, then from the traditional and Roth IRAs. This is going to be the most tax-efficient method for spending down their nest egg. We are also going to want to use asset location in addition to our overall investment asset allocation. Now, what asset location is putting the right type of investment in the right type of retirement account. So in this case, in particular for Charles and Laura, I would want to take all of our interest-producing investments, right? Usually our conservative investments, like our cash, like our money market, like our CDs, like our bonds and bond funds. I want to shelter all of those inside of the pre-tax account. And the reason reason why is because all of those interest payments that we're receiving are now going to stay sheltered in that account and not hit the tax return. Now, also means is that more of our growth-oriented investments are in our Roth account and our brokerage account. When these assets that we expect to see capital appreciation in grow, I want that to be in that Roth account where growth and withdrawals are tax-free. Similarly, in the brokerage account, in this instance, at these tax brackets, at the married rates for Charles and Laura, we can expect that capital gains are going to be taxed at 0%. And that is such a big deal. And so the brokerage account is actually going to be another tax advantaged place if we have the right investments there. So I really like this asset location strategy where these are the asset classes we're going to hold in each of these three types of accounts. What that's going to do with the correct withdrawal strategy and the correct asset location is it's going to open up a ton of room on the tax return to really implement some strong tax planning here. And we're going to do that in this case with Roth conversions, where we can now move money from the pre-tax account, move it into the Roth, and we will actually be better off in the future, especially in the case of we need to hedge the passing of a spouse. Because in this situation, actually, Charles and Laura could just withdraw money from their pre-tax IRA and they would be in really great shape tax-wise. And they can do that successfully if they were to both live a 30-year retirement together and pass away at the same time. They would be well off doing that. However, we need to be intentional and plan for what could happen so that one of the two of them does not have to make a major lifestyle change or go back to work. So what does this actually look like? So let's say we are spending down that taxable account, right? We're spending our cash and brokerage money. This is what our tax return is going to look like. This is a snip from my professional tax software, so it is not going to look pretty, but it is going to tell us everything that we need to know. So this first column here, we pretty much have no income, right? Because we are drawing down non-IRA money. We're going to have zero. Standard deduction is $31,000 in this case because we get a little bit more after age 65. And so if we look at our taxable income, it's zero. We don't get negative $30,000, and therefore our tax is just zero. There's no carryover to next year. We need to be diligent about actually making use of this standard deduction here. And so in this case, we could just draw what we needed from the portfolio from the pre-tax IRA and spend this down. And this is what our taxes would look like. It would look pretty much zero here. However, what we're going to want to do is actually Roth conversions in the same amount, which would get us to the same taxable result today, but it's going to prepare us or prevent a tax problem in the future. And so let's take a look at what that might look like. So this is what taxes are going to look like at the passing of first spouse. And again, hopefully this is way down the line and not anytime soon. But we need to be prepared for something like this to happen to make sure that the surviving spouse does not have to go back to work. Let's look here. In order to maintain the same $5,000 a month, if we did not do any Roth conversions, right? We spent down the brokerage money already. We now just have our pre-tax and that small Roth account left. It looks like we're going to need to spend $39,000 from the IRA, in addition to what we're going to receive from Social Security, because we're going to get to keep the higher of the two, right? We're going to lose the $1,200 Social Security check. Our total income is going to be $58,000. Standard deduction goes down quite a bit, as you can see here. And so we were looking at $41,000 of taxable income. This is the very top of the 12% tax bracket, and that's about $4,800 in federal taxes we're paying. I'm not even factoring in state at this point. And so that $39,000 includes the extra amount we would have to pull out to then send as withholding to pay that tax. But let's talk about if we were to actually do those Roth conversions earlier on. If we were able to get $25,000 a year converted, and that might only last for 2 years because we're spending down the brokerage account, and then we could do small conversions after that, or just spend down the pre-tax account. What that could look like if, for example, Charles passed away 10 years later, we can actually split our spending from the traditional IRA and the Roth IRA. So now we're taking $17,000 of pre-tax money and $17,000 of Roth IRA money to get us to that same $34,000 of spending need. What you'll notice is that we don't need the additional $5,000 because we're not paying any tax right now. So that means our Social Security, right, this other income here, only $2,000 of it would be taxable, as opposed to almost $20,000 of it because we're taking out more. That's because the amount our Social Security is taxed is on a sliding scale. And the more income we have, the more of our Social Security check gets added to our tax return. So let's look at total income here, right? We're going from $60,000 of income to $20,000 of income, even though we're still going to spend the same $60,000 a year. After the standard deduction, looks like $2,000 of taxable income, paying $246 in tax. This is a huge deal because if we looked at the math on just how much extra has to come out of the savings, right, out of the IRA to pay that tax, it substantially increases our withdrawal rate. And that is something that could be very, very straining on our portfolio and on our retirement plan. And so something like this saves the surviving spouse a substantial amount of money. If you just look at this for a 10-year period, right, $4,800 a year, that's $48,000 in tax savings over a 10-year period if your spouse were to pass away early and you're to live 10 more years. That is substantial savings. And the savings at that point is less important than you don't have to make a major financial lifestyle change and or go back to work because something like this happened. We were being intentional with our tax strategy, and that is something that could absolutely save the retirement plan in a situation like this. Now let's wrap up talking about investments because this is going to be what funds the whole thing, and it's very, very important. So first thing I noticed and that I want to address is that Charles has a 401k plan, and that's going to be where all the traditional IRA money is withdrawn from. Therefore, we need to think, is a 401k better or is an IRA better? Now, in this case where they're going to be retired, what's important to keep in mind is that the 401k usually has what's called the pro rata rule, meaning that if we need to take $10,000 out of the 401k and we are invested 60% stock, 40% bond, that $10,000 is going to consist of $6,000 of stock and $4,000 of bond. As the markets go up and down, that could be problematic because if we have let's say a major downturn and we need to make withdrawals, we might not want to sell our stock positions while they are down. Therefore, in an IRA, we can pick and choose what gets bought and sold and when and why. And we can be really intentional about this, which is really important if we are going to successfully retire with $500,000. Therefore, I have the second two bullet points. We want to have separate buckets of money tied to separate goals. So I like using a buffer of conservative money that we're going to use for spending, right? And that's usually going to be CD ladder or bond ladder, right? Very short-term money that we want to count on being there so that we can spend it. And the rest of the money is going to grow. That's going to be usually our equity investments that are going to see market fluctuations, but that's okay because we need that long-term growth so that we can keep refilling that income bucket. So like I said, I like to have at least 5 years worth of income. So in this case, Charles and Laura are spending $35,000 a year, and that's actually going to be 35% of their portfolio. So they're actually going to be in a 65-35 allocation instead of 60-40. And I think that's really important to acknowledge because we shouldn't just be 60-40 allocated because that's what a rule of thumb said we need to be at in retirement. We want to be intentional with how we're invested, and therefore we're actually at a 65-35 allocation because it aligns with our spending goals. So as you can see, everything that we just talked about is very, very intentional, and each strategy is directly in line and directly connected to a desired outcome. And that is what financial planning is all about. It's about being intentional so that we can achieve what we said was important to us. And so I hope that you can use this case study as an example and that you can find confidence in your retirement plan and see success. Thanks for watching.